What is going on with Silicon Valley Bank? We've gotten this question a lot lately. Let's dive in and talk about it. I'm Jonathan Bednar, certified financial planner. Today we're going to talk about what I'm calling the banking crisis 2.0. Silicon Valley Bank. It's made a lot of headlines over the last 2 weeks or so. There's a couple of other banks that have made some pretty crazy headlines. Signature Bank, First Republic Bank, we're seeing Credit Suisse Bank overseas. So there's just a lot of kind of concern about what's going on. So let's rewind. We'll give you a rundown so you can understand what's going on, how it affects you, and what you should be thinking about. Prior to COVID, Silicon Valley Bank had roughly $60 billion in deposits. Now, Silicon Valley Bank is a bank that spends a lot of their emphasis and their business practice catering to, obviously, Silicon Valley. Tech startups, venture capital firms, even larger tech businesses. And so they do not have the same clientele that some of the other regional banks around the country have. So when COVID happened, Silicon Valley Bank had $60 billion in deposits. Throughout COVID, we saw a huge influx of capital. And so a lot of these tech companies and tech startups were flush with cash, and Silicon Valley Bank's deposits increased by threefold. They went from $60 billion up to about $200 billion in deposits. Now, Silicon Valley Bank does not have the same business model that a lot of other banks do. Because they cater to venture capitalists and tech startups, most of the venture capitalists are the ones that are loaning money to startups, to tech companies. They are either making those loans to those businesses, and or they're giving a whole bunch of cash infusion into those businesses in exchange for ownership in those tech companies. It's called seed rounds, and so they're making early investments into these companies before they are publicly traded. So what happened was, Silicon Valley Bank only has about maybe 10 to 12% of their business is through conventional lending, whereas most other banks are loaning, 40, 50, 60% of their business comes via lending. And so there's a huge difference in the way that banks, Silicon Valley Bank and other banks, are structuring themselves to make money. Banks make money off of what's called net interest income. This net interest income is what pays the bills, pays salaries, pays for property, pays for taxes, pays for all the things to run the bank. Again, most banks are using, they're taking in deposits. They are paying out at 1 or 1.5 or 2% nowadays. Prior to COVID, they were paying 0, and they're loaning on buildings, on businesses, on real estate, on motorcycles, on whatever else at 6, 7, 8, 9, 10%, whatever it is. So if, let's just say they're paying a loan at 8% and they're paying someone 2% on deposits, the bank is making a 6% spread. The 8 minus the 2 gives the bank 6%. So Silicon Valley, not in this same lending capacity, has to find a way to generate income to pay the bank's expenses and employees and insurance and all the things, all the expenses. So what they did is they went out and bought 10-year treasuries. This is, when rates were still at essentially 0, you could go out and get a 10-year treasury at 1.5%. So they took a whole boatload of this money. Remember, the deposits tripled from 60 billion to 180 to 200 billion. So they had a lot of extra cash they need to find a way to make money on. So they bought these long treasuries, 10 years, at 1.5%. What happened from there is the Fed started aggressively raising rates to fight inflation. And so as you recall, we've gone from a zero interest rate policy to now interest rates, the Fed interest rate is around 5%. The target interest rate policy is around 5%. So we've seen a huge jump in interest rates, and that has caused prices of fixed income, the ones that were yielding less, to go down. So interest rates and fixed income prices have an inverse relationship. I like to show this on my pen. When interest rates go down, the value of your bonds or fixed income goes up. When interest rates go up, the value of your fixed income or interest rate investments go down. So as rates have gone up, we've seen the value of these low interest investments go down. So let's continue on. The banking industry, these tech startups, these tech companies have needed capital because their businesses started to slow. There's less people using them. Interest rates going up has had an impact on their margins and the way they invest. And so there's just been a lot of things that's caused this kind of the tech world, especially these startups, to slow. And so they've started to kind of dip in to their deposits that were at Silicon Valley Bank, and that has caused their bank reserves to go down. So what Silicon Valley Bank had to do was they had to sell about $22 billion of their 1.5% 10-year treasuries. And when they did so, because rates had gone up, the value of their investments had gone down, they took a loss on those investments to the tune of about $1.8 billion. And they did that because they had to free up liquidity to be able to provide depositors who were taking money. When they did that, they started to initiate a capital raise to just kind of shore up some of their balance sheet. Once they asked for that capital raise and they took a loss on those bonds, we saw some very prominent people start shouting from the rooftops, "Get out, get out!" When that happened, it put a run on the bank. We had $42 billion of asset requests to be taken out of that bank. 2 days later, we essentially saw the collapse and the insolvency of Silicon Valley Bank. There are a lot of fingers to be pointed here. The Fed raised rates really, really aggressively, really, really fast. There was a lot of mismanagement in the way that Silicon Valley Bank ran their investment portfolio, not making traditional loans, really having concentrated investors that were above the $250,000 FDIC insurance limit. And then you've got some prominent people coming and yelling, the world's ending, get out, take cover. And so all of these things, this culmination of events that happened was really the perfect storm that ended up leading to the demise of Silicon Valley Bank. Now, that spread to a couple of other banks, and there's still some hysteria around what if that happens to my bank? What if it appears they're fine one day and the next day they're not? And what I want to say about these bank runs is it's a very slippery slope. These banks can look very, very healthy, and then all of a sudden a bank run causes their capital ratios to get out of balance. The bank becomes insolvent pretty quickly and ends up getting shut down and taken over by regulators. What's interesting is I think the Wachovia bank failure back in the great financial crisis of 2008 took, I want to say it was 16 days to collapse, to fail. It took Silicon Valley Bank 2 days to fail. And that goes to show the power of social media, news spreading, and how quickly we access information and how that can impact, some of these banks. So what do I think you should do? What is the takeaway for you? The takeaway for you is that before you make any investment decisions, take a deep breath and think about, is this really accomplishing the objective you want? Don't get in such a panic that you make a rush emotional decision. That's essentially kind of what caused the run on the bank. Everybody got panicky and pulled out. I think that it probably could have been overcome if cooler heads prevailed. Not to say that Silicon Valley Bank didn't have a lot of mismanagement issues and make some very poor investment decisions. They obviously did. But I think that it probably could have been resolved. The biggest takeaway that I think you should do is if you're a person that keeps assets or money at the bank, deposits, or you're a business owner that has deposits at the bank, you need to kind of think through from a cash planning perspective, is my money safe here? Do I need to keep more than the $250,000 maximum insured limit? And if not, if I have more than that, am I okay with that risk that it might not be insured? What if my bank collapses? Maybe you should spread out money to a couple of different banks so that, if one bank does collapse, you're under the threshold of insurance, so you don't have to worry about, losing the money. And secondly, if your bank collapses, it'd be pretty easy to switch if you already have another one in place so that you can continue to buy raw materials, make payroll, and your operation of your business continue to run without being at the mercy of, is the bank going to open up tomorrow? So that's something to really think about when you are doing, thinking about your finances and your bank finances, your investments, your portfolio, the way you're operating your business, whether it's a business or it's just your family. All of these are very important to consider as part of your personal financial plan. With that said, I want to thank you for listening. If you haven't already subscribed to the YouTube channel, please do so. You can do it right here. Thanks for listening. Have a wonderful day. Be confident in your retirement.